Hi, I'm Jim Juback, and welcome to Juback Asset Management YouTube video for Wednesday, February 12th. If you haven't noticed, I've moved to Italy, specifically in Venice right now, and started a Substack called We Moved to Italy, about my adventures here. Just posted a piece that I'm very happy with, and you can read it on Substack. As I said, We Moved to Italy. It's about our road trip to Mantua and visiting the two Gonzaga palaces there, as well as eating some really, really great Mantua specialties, particularly tortelli de zucca, which is basically pumpkin ravioli. Just unbelievably good. Okay, anyway, if you like this video, please subscribe to my YouTube channel. It's free. You get notification when we do our next ones, about 3 a week. And as I said, that's free. You can also get my free stuff on jubackpicks.com. That's got 3 portfolios, 12 months, 12 to 18 months, 5 years, and dividends. Usually about 1 or 2 posts a day. That's free. My subscription site, which has got 2 to 4 posts a day and 6 portfolios instead of just those 3. So those 3 plus volatility portfolio, an ETF portfolio, and a really long-term portfolio. And then the Substack. And you can find links to all those down below. Today, I'm going to talk about the gradual move on Wall Street from a belief that everything is going to be hunky-dory because Trump really doesn't mean all this stuff that he was going to say about mass deportations, and more specifically doesn't mean all he's going to say about tariffs, to a belief that basically says, hey, yeah, he was really serious about this stuff. On February 10th, Monday, he announced new tariffs, 25% on steel and aluminum. The two of the 5 big sources of that are Canada and Mexico, the countries that he was going to put 25% tariffs on, but then decided to delay that for a while. Anyway, these tariffs have a date of March 4th. So clearly serious. We've got EU tariffs coming up, but here's the shift on Wall Street that I find really interesting. And that's why this video is called, Is Wall Street Writing Off 2025? What I'm starting to see is commentary from these places like Bank of America and Wells Fargo and JP Morgan that are saying, hey, we've got a lag problem here, that the things that are going to negatively affect growth and revenue and interest rates and all that are going to take effect really pretty quickly in 2025. The things that are supposed to, in the Republican scheme of things, supposed to add to growth, like the tax cut, like deregulation, those things are going to take longer to take effect, and they're probably 2026 or later. So the view that's now starting to emerge, I think, is that, well, for 2025, we're going to see negative stuff. And the negative stuff may be exacerbated by the lag in Fed policy, that the Fed is basically looking at this stuff and going, hey, things are so uncertain that we're probably not going to cut interest rates in 2025 as we wait and see what all this means. So that basically what Wall Street is saying is that 2025 looks like it's going to be a year full of negative risks, downside risk, whereas 2026 might be a time of upside risk if we get the renewal of the Trump tax cuts from 2017, as well as some relief in particular industries from deregulation. I don't know whether that's a real thing or not, but this is the Wall Street paradigm that I think is emerging, which basically means that, hey, the market may not go down in 2025. I think that's going to largely depend on perception of what the Fed policy is, as well as the perception of what the fight is in Congress about the budget. Remember, this The continuing resolution runs out on March 14th. We still don't have a budget for fiscal 2025, the year that started in October 2024. And we certainly don't have a budget yet announced for the fiscal year that starts in October 2026. All this means that 2025 is going to be a tough year for stocks to go up. 2026, Wall Street is saying, is going to be much better. So if you're starting to see this shift in sentiment, I think the sentiment is going to focus on sort of the near term versus the longer term and say, hey, maybe I don't want to be in the market a whole lot in 2025. Okay, that's the view that I see emerging on Wall Street. That's the changing sentiment that I see about where this market is going. And you need to figure that into your portfolio allocations. I'm basically trimming positions and selling and moving a little into gold as we head into 2025. If you like this video, please give it a thumbs up. Subscribe to my YouTube channel. That way you get notification when we do our next one. We're doing about 3 a week. That's for free. You can also get my free stuff on my jubakpicks.com website. That's 3 portfolios, 1 or 2 posts a day, free. Subscribe, you get 6 portfolios, and that's Jubak Asset Management, 6 portfolios instead of those 3. So you get the 12 to 18 month, the 5-year, the dividend, an ETF portfolio, a volatility portfolio, and a really long-term portfolio. And that's if you subscribe to my Jubak AM site, as well as I said, I moved to Italy in September 2023, living in Venice right now, which is where this is coming from. It's about 6 p.m. your time. The market has, if you're in New York, is closed. It's a little after midnight here. Anyway, if you want to follow my adventures as we roam around Italy, most recent post is about a road trip we took to Mantova to eat pumpkin tortelli, unique to Mantova because they have their own variety of pumpkin found nowhere else, as well as some really interesting art museums. Anyway, if you want to read that post, that's a free Substack called We Moved to Italy. You can find links to all those down below. Thanks very much for watching.